Hello everybody, Luke Gromen, FFTT. Hope you are well and having a great week. Thank you for joining me. Appreciate all the questions, really helpful and thought-provoking, which is very helpful, and always enjoy looking over them. So with that, I'm going to jump right in. First question is from George. What do you think the effects will be of this tremendous family fiscal impulse playing out? And what he's referring to is boomers hold half of America's wealth, but they're going to spend it on themselves before their kids have a chance to inherit their money, according to Business Intelligence. In my opinion, in the short term, it's stimulative and inflationary. Essentially, U.S. policy was to incent the boomers to defer compensation that would have added to inflation in the real economy throughout the 80s, throughout the 90s, throughout the 2000s. By deferring that comp into asset prices. And then U.S. policymakers never counted asset inflation as inflation, which was very convenient for keeping inflation low, which ultimately was all done in deference to the bond market. In low inflation, low rates, makes it cheaper for the government to borrow. Okay. That worked great until the boomers wanted to start retiring and wanted to start spending their money. And now we have 40 years of paper asset gains that are now coming back into the real economy and causing sustained, sticky inflation. Critically, the boomers are nearing the end of their lives. That is a hard stop. And as a result, there is little to no ability for the Fed to change boomers' time preference. They can crash asset markets by raising rates really high. That it won't work ultimately because the Fed needs rising, or the U.S. government needs rising asset prices to drive rising consumption, to drive rising tax receipts to service the debt we have. And there's really no rate the Fed can raise rates to that is going to, short of just outright crashing boomer wealth dramatically, there's no rate the Fed can raise rates to in any real way that will dissuade the boomers from spending before it creates severe problems for the U.S. government's ability to finance itself, given 120% debt to GDP. So, in the short run, I think it's ultimately good for growth, good for inflation. In the intermediate term, you would think a lot of this money will get spent on long-term care, healthcare, etc. And that has implications that would shift away from sort of more discretionary consumer goods and services. And then longer term, as the boomers pass on, I think it's essentially a lottery ticket to the extent the wealth continues to be there, some portion of it. I think it's essentially a winning lottery ticket for their kids. It goes to them, and the kids will be, in a lot of cases, just around their peak spending years. So I think it's a trend of, it'll delever some of their kids, right? You can pay down college loans, etc. But ultimately, I think it's stimulative and inflationary. From SG, how much longer until the dam breaks and we get a big recession or high inflation? Have your opinions shifted? And 2, worst case scenario in Middle East happens. There's closures and disruptions to the Red and Arab Sea. What happens next? The deficit, to answer the first question, my opinion shifted? No. Why? Deficits of 8% of GDP and unemployment at 3.6% tells us one of two things or both are coming. Economic recession or high inflation, or economic recession then high inflation. It's only happened, this gap has never happened this big as it is now between deficits and unemployment. And we've shown that chart before. You saw a brief moment in 2019, and before that you saw a moment in 1968. That's basically it when these two data series are moving in different directions. And in both cases, you ended up with sustained high inflation. And in one case in particular, COVID, you had a nasty recession for a cup of coffee before you had that sustained inflation. So I continue to think that's where it's going. I don't know if we get a nasty recession first and then we get inflation, or if we just go straight to inflation. And to be honest, I'm positioning as if I don't care. I'm unlevered. I have high conviction that we're going to end up at that end game one way or another, and so it's just about getting my chips from here to there to benefit. In terms of the worst case scenario in the Middle East, I have no opinion on whether it's possible or not, so take this with a grain of salt. If you had closures or disruptions in key trade lanes in the Red or Arab Sea, you'd have oil up big, gold up big, dollar up big, treasury and global sovereign bond yields up big, in my opinion, and stocks globally down big. If it went to outright war between great powers, i.e. U.S. and Russia, U.S. and China, anywhere in the world, I think you'd very quickly see capital controls across global markets in the West as well as in the East. And I think you'd see rationing of commodities. And I think sort of the world, the commodity, the global economy as we understand it and see it today would essentially cease to exist almost overnight. So I don't think that's going to happen. I also think that there are some that hold a view that could happen as a tail risk, but that we would just continue to have the markets we have today, and I don't think that's the case at all. Chris, if you were Emperor Luke and you wanted to move the U.S. In line with BRICS Plus and their vision of sounder money or more balanced trade, what policies would you enact and how would you shape the narrative to do so? So for me, the BRICS are just trying to push the world towards a multi-currency energy neutral reserve asset that floats in all currencies settlement. In other words, price oil in whatever you want, settle net deficits in gold at a floating price that floats in all currencies. That's where I think they are demonstrably moving the system toward with their actions. If so, what policies would you enact and how would you shape the narrative to do so? Bonus question, would your plan look similar to what we're doing now? I would do industrial policy investment in the U.S. We're doing some version of that. I would do skilled trades and engineering college trade school subsidies. So you get free college if you go to school for engineering or for trade school in the skilled trades. There would probably have to be a service aspect on the back end of it. In other words, if you take advantage of those subsidies and get free school, you've got to work in that industry for 8 years, something akin to what you do with ROTC, Reserve Officer Training Corps here in the U.S., or the military academies. You go there, you get free school, and then you got to serve. I think the obligation is 8 years active, 4 or 8 years reserves, something like that. But I think you could structure it in that way because right now we are not too many years away from having a supply problem in the skilled trades and to a lesser extent in engineering. So in some respects, I do think we're seeing shifts in that direction. Ultimately, once you had some momentum building in that direction, I think you could do some things that would support the movement toward using gold as a neutral reserve asset. Ultimately, Bitcoin could serve that role too. I just think between here and there, it's probably at the very least gold before Bitcoin, but we'll see. And settling deficits in gold at a floating price would certainly do that, but that would have to be down the road after we've backfilled some of the and reshored and backfilled the skilled trades and engineers we need to do those things. From Bill, has Japan lost control at this point? Is that a large enough factor to trigger global disruptions such as treasury selling? In my opinion, they haven't. I think what we're watching is a managed decline in the yen, managed rise in Japanese in JGB rates. Japan has a lot of firepower in the form of their net international investment position of dollar assets. It's about 60% of Japanese GDP. Positive, held largely in dollar assets. Just think of that as a piggy bank that they can use to finance their own deficits. As they sell those assets to support their own currency, finance their own deficits, that ultimately throws the problem back onto the lap of the Fed. At the moment, lower oil prices, lower coupon issuance, Treasury coupon issuance per the quarterly refunding announcement last week, slightly lower dollar. All of these things are helping keeping the movements sustainable, not that disruptive. So far, so good. From Max, hi Luke, can you comment on the Fed curbing rehypothecation of treasuries, i.e. effectively charging a hefty tax or full margin on leverage in the treasury market? Will this increase demand for treasuries meaningfully, or is it rearranging deck chairs on the Titanic? And what Max is referring to is something our friend Stimpy wrote. For what it's worth, the SEC is going to drop a bomb in treasury markets later this month with a full clearing mandate of customer trades with a short implementation deadline, a timeline. The glory days of rehypothecation are over, and deleveraging is going to securities finance like a Mack truck. Essentially, I don't know I've not seen anything. I know Basel has talked about it on some level, but I don't know specifically about the legislation that is reportedly set to hit, according to Stimpy, later this month. And I know Stimpy. I know who Stimpy is. I would trust Stimpy. If he says it's happening, then that's something to be aware of. I have no reason to think he doesn't know what he's talking about because, like I said, I know who Stimpy is. He's really good. So, with that said, it would essentially be deleveraging. Sharp deleveraging possibly, and yes, in my opinion, I agree it would drive demand for treasuries. Essentially, it would be a large tax on leverage. The problem is if it drives a decline in asset prices, which it almost mathematically would be certain to do, it would likely drive a recession, drive a decline in tax receipts, a recession through the consumption impact of the lower asset prices, which we saw last year. Decline in tax receipts, a rise in credit issues economy-wide, a rise in the dollar. And so when you sort of talk through each of those things, a recession, that's going to drive your deficits up on a slight lag by 6 to 8 points of GDP. That's $1.5 to $2 trillion more in treasury issuance. Asset price declines hurt consumer spending, they hurt tax receipts, that drives issuance up. For example, last year, unemployment never really budged, asset prices fell, tax receipts fell almost $500 billion. So assuming, so if we have a modest recession, asset prices fall, that would be another, so we got $1.5 trillion to $2 trillion on a modest recession, more issuance, $500 billion to $1 trillion more in deficit, more issuance on asset prices falling depending on the severity. Rise in credit problems, economy-wide, given deleveraging. That's going to force banks possibly to sell treasuries to raise capital. They own $4.1 or $4 trillion in treasuries and mortgage backs. They could sell to raise dollars to address credit losses elsewhere in their books. And then the rise in the dollar that would ostensibly happen given a scramble for treasuries, a deleveraging event. Foreigners would also have to sell treasuries to raise dollars to defend their currencies. Foreigners currently own in total around $7.6 trillion in treasuries. So, would it drive demand for treasuries? Yes, in all likelihood it would, for a moment. In the same way that pouring gasoline on your furniture and your carpeting and then lighting it would keep you warm for a little bit. However, when you start talking about the amounts of net effective treasury issuance they could come to bear, right? $2 trillion deficit, in another $1.5 trillion to $2 trillion if it drives a recession. Okay, 2 plus 1.5, 3.5. Another $500 billion because asset prices are down like 2022. Okay, that's what did I say? 3.5. That gets us to 4. Now the banks are going to sell, let's say, another $500 billion. That gets us to $4.5 billion in effective issuance. Now let's say foreigners sell another billion. That's or another trillion. Excuse me, billion. That's cute. Another trillion. 4.5 plus another trillion minimum. That's $5.5 trillion in net effective treasury issuance. Who's a buyer? Banks are selling. Fed's selling. Oh, I forgot the Fed. QT. $6.5 trillion, not $5.5 trillion. Silly me. $6.5 trillion of net effective treasury issuance. That is just over $525 billion of net effective treasury issuance per month into an economy globally that grows GDP, let's say 90 trillion economy, growing, let's get aggressive. Let's say 4 trillion, or let's say it grows 4% nominal. That's 3.6 trillion in growth that's going to need to address 6.5 trillion in net effective treasury issuance. Not enough balance sheet. What do? We'll sell more assets. Okay. Accelerate that. Now it's not 6.5 you need, now it's 7. Uh-oh. You see what the problem is here. So it can drive a bid for treasuries in the short run. But make no mistake, it would drive a deflationary spiral that continues until either the Fed says, stop, we're doing QE again, or you get to a situation where rates are rising in a severe recession, receipts are falling, and your interest expense in the U.S., other global sovereigns, goes above tax receipts, and the central banks either have to stand aside and let the debt default or print the interest. And once you print the interest, it ain't deflationary. So it could work, but again, it's like burning your furniture to stay warm. From Michael, if Luke was an ordinary person with his macro views and had only 5 to 7 market, finance, economy screens to look at every week, what would those be? I am just an ordinary person. I just am very interested in this stuff. But I'd look at the Wall Street Journal. I would have a curated FinTwit or X or FinX or whatever we call Twitter now feed. I'd read a lot of economic history books. And then I'd probably own 10 to 20% in gold and Bitcoin. And then I'd have a sort of a standard diversified portfolio of stocks and short-term bonds. And then I'd focus on building a business doing something that I loved. And I'd leave it at that. And the last question from Bert. What's your favorite thing to do in your free time? I like to spend time with Mrs. FFTT and my 3 boys that are they're all young men now, which has been awesome. It's been the best experience of my life. I like to work out, lift, row, hike. So it's those are the things I like to do. So I appreciate everybody joining me again. It's always very enjoyable. Really helps me think and try to look at things a different way, which I always love to do. So at any rate, if you like these updates, check us out, FFTT-LLC.com for more information about what we're up to and our different product offerings. And in our Tree Rings product, 10 most interesting things, brief synopsis on what grabbed our attention about them and whether they're making us think differently or similarly about various topics in the world, relative to how we had been thinking about those topics before we had read those things. So, as always, thank you for joining me, and everybody have a great rest of your week. Take care.